Well, the consumer credit index edged up 0.7 points to 49.9 in the fourth quarter. The rise in the index is seen reflecting a moderation in the growth of revolving credit facilities used by households to supplement monthly income and some stabilization in consumer loan impairment rates as well. Joining us for more detail on this is Russel Lamberti. He's an economist at ETM Analytics. Russel, thanks so much for joining us this afternoon. Well, looking at the figures, it's steady as she goes. Should we be happy that we're looking at stabilization on this front, even if it is with a negative territory? At least it's not a deteriorating picture we're looking at.
Correct, Alishia. Yeah, to some extent, the sort of stabilization in the index that we've seen over the last 2 or 3 quarters suggests that consumer credit health, while certainly not improving, is not necessarily deteriorating further, which I think is some fairly upbeat news that we can take out of this. And I guess to some extent it reflects, a lending market and a credit extension market that is kind of not too strong at the moment, not running too far ahead of itself. And as you pointed out off air, we have seen some of the banks, explicitly state that they're going to start to pull back on some of their lending activity into this market. So at the moment, it seems to be that consumer credit health is fairly steady.
Russell, you talk about the South African consumer. In fact, I'll read one line from your report. The index and its subcomponents currently indicate that the risks to South African consumer credit health are fairly balanced. I spoke to 2 companies yesterday. One was Seckam, the other one was African Bank Investments Limited. 2 different companies operating within South Africa, 2 completely different consumer types fueling their businesses. I mean, how useful is this index given the almost 1, 2 or 3 speed consumer market in South Africa?
I think that's a great question, Lindsay, and there's no doubt that if you really want to unpack some of the nuances of the South African credit market, you've got to dig into some of the differences between income groups. Even geographically, we see different credit patterns and so on. So certainly there's always room for greater disaggregation and any kind of when we get more granularity on these things, we get better insights. But at the same time, I think from a macro perspective, what we're really interested in, and what a lot of the markets are interested in, and even business people, are the broad, big business cycle trends that we see. And so looking at these in aggregate gives us a good sense of where we are in the business cycle. And this to a large extent shows us that the credit cycle is in a very neutral position right now. So at a macro level, that has implications for growth in durable goods sales, growth in vehicle sales, and various other sort of macro elements that we're looking at. So I think there certainly is value in looking at an aggregated picture of the economy. But you're absolutely right. There's always going to be greater insights as you get more granularity on what is clearly a very disparate market in South Africa.
Of course, we're looking at aggregates here. I mean, overall, does it tell of a situation where you're finding a South African consumer that's becoming a little bit more responsible in a tough economic climate, or banks that are just becoming a little harder to please?
Look, I think the answer is probably a bit of both. We've been through a very rough credit cycle in 2008-9, build up in 2006-7, and so that has impacted people's credit records, for example. It has impacted behavior, there's no doubt. And at the same time, the banks don't want to have a repeat of that whole cyclical process again. So certainly not anytime soon. It's very fresh in the memory. So I think there is evidence of both, more cautious borrowing on the part of consumers, and more cautious lending by banks. Of course, people will immediately say, well, what about the unsecured lending space? And I think we need to get good perspective on that. That is one portion of the market. That is a pocket of the overall credit market, which is actually largely dominated by mortgages and vehicle finance and all these other areas. So the unsecured space is there. It's been growing very quickly. There are some concerns around it. Some of those concerns are legitimate concerns, and some of them are probably not that legitimate, in the sense that there's maybe a sense of over concern in that unsecured lending space. But certainly as a whole, the credit markets are not sort of moving in a sort of irresponsible, unsustainable direction.
I heard a statistic, Russell, that said that 9.2 million South Africans over the age of 18 were impaired, whatever that impairment means, whatever form it takes. And if you say that 9.2 million as a percentage of the total population is just below 20%, but then you take it that it's over 18, it comes up to close to 50%. That's a scary figure. The report that I'm quoting from says credit providers will need to remain vigilant since overly robust lending could begin to push more consumers into a position of deteriorating credit health. To me, that's a real risk in 2013. And the other thing, despite the fact that we've been talking about a 25 basis point cut in interest rates with our previous guest, what happens when there's a 25 basis point increase, or 0.5% or 1%? There's a lot of consumers that won't quite know how to handle that.
I think you've raised some fantastic points, and my interpretation of where the index is currently is that we're sitting in a very neutral level where consumer credit health is neither deteriorating nor is it improving. And as you rightly say, if we continue to push credit into this consumer market, and if we do see the kind of uptick in price pressures that certainly a weak rand would suggest we're going to see in 2013. There's no question that the risks to this index, would lie to the downside, and that we would actually start to see a deterioration in consumer credit health. And again, rate hikes only impact the affordability of that credit at the margin in a negative way. So this is by no means the kind of data point that we look at and sort of jump for joy. I think there's kind of an even balance of risks at the moment, but certainly, if there's continued aggressive lending into certain consumer markets, if price pressures start to catch up next year, then this cycle is going to turn a little bit nasty. And I think that's something that has to be borne in mind. And I think that is why we are seeing credit providers starting to get more cautious, and they're very actively looking at the profile of their customer base. And trying to assess the sustainability of that. So a lot of vigilance is undoubtedly required at the moment.
Not only do they scrutinize their profile base, but they look at how they're lending. When we look at vehicle sales on a monthly basis, we talk to the likes of the West Bank, and continually emphasized is the restructuring of loan terms, where you're looking at extended periods of loan, and that making credit a little bit more affordable. Just how much of risk does that now bring onto the table?
It does. It does bring risk. I think whenever you start to get manipulation of credit terms and extending terms, and all these kinds of policies are ultimately moving in towards that sort of unsustainable sort of territory. And again, it's to underscore the point that I don't think that we're in the clear by any means. I think we're in a tough credit cycle. Lindsay mentioned some big numbers on impairments, and I think that ranges from highly impaired consumers who are just completely in default. It probably to some extent overestimates the problem in the sense that if someone has moved 1 month in arrears on one account that they have, they're considered impaired. That we would argue that would be considered a very mild sort of rate of impairment. But that aside, there's clearly a credit problem. We've come through a big credit bubble. It hasn't been fully deleveraged. We know that, and we know there's this overhang of debt sitting in our economy. Our index is showing that is not at this stage becoming a worsening problem. So to some extent, households and credit providers are managing that problem, but it's still sitting there as a systemic problem.
So it's certainly a problem that hasn't